everybody. This is Eugene. I'm the CIO with Signet Financial Management, and today I will update you on the stock market. Please take a look at our disclaimers and disclosures. Today we'll talk about first of all, I'll give you the overview of U.S. equities. We'll talk about the size and style dynamics. I'll update you on the yield curve and short-term interest rates. We'll look at valuation spreads. We will talk about which factor groups work and which don't in the current market environment. We'll look at factors that work on the micro level. And we will talk about our portfolios and rebalancing we recently did. We will also have an intro of our new strategy, small cap portfolio. So obviously, lately the news have been and the markets have been dominated by coronavirus. The spread of the virus is, continuing around the globe. I don't think we will see a possible containment of the virus, but from the conversations I had with the medical professionals and infectionists, we will see more of a pocket of the virus in multiple areas. So nobody knows the exact impact the virus is going to make on the economy in the U.S. and globally, but there's definitely going to be an impact. In the long run, we still believe the environment is very supportive of U.S. equities. And at this juncture, we're taking a barbell approach to our stock portfolios, where we have a bit of growth, a bit of value, and we still have a very strong GARP representation. We don't see recession from the traditional economic indicators and from the bottom-up analysis yet. But what we do see is that we need to be cautious in the next 12 months. And even traditional macro and micro factors tell us to take a more cautionary stance. And I will show you in the sector forecast how it does get demonstrated. So the fear of the virus can change things in the short run by people buying less, traveling less, having a serious impact on healthcare systems. But in the long run, we don't think the virus is going to derail the world economy from growing and the U.S. economy from enjoying the full employment. At this juncture, with the latest fears resurfacing, we see growth still being preferred in the marketplace. And as you can see from the value growth dynamics, where value outperforms above the red line and growth outperforms below the red line, that we still see a very prolonged dominance of growth style. Valuation spreads shot even higher, almost reached the level of 2018. Actually surpassed the level of 2018 and almost reached the level of Great Recession. So we are in a pretty highly distressed market. And valuation spreads show by how much expensive stocks, companies with higher PEs, stronger growth, how much more expensive they are in comparison to companies with more timid growth projections, the value stocks. In terms of size, small caps have been in the doghouse for a very long time. They continue to do so. And obviously, with the virus fears, people will prefer large companies more, which are perceived to be more stable. So I don't think we will see in the short run the change in the taste, but small caps have been, as I said, underperforming, have been underperforming for a very long time. So at some juncture, there's going to be a trigger moment, and it could be a technical recession or some other distress where executives around the globe will postpone or reduce their IT spendings, and all of a sudden we will see a slowdown in the large cap, pretty much tech growth leadership, and that might trigger actually the change in the broader leadership across the market. Short-term rates are the term structure obviously is moving to inversion again, and we will monitor the situation. But there are a whole bunch of things which right now are pretty much unknown, and that's why judging by the yield curve is very questionable, especially with Federal Reserve aggressively intervening as we speak. They just lowered the interest rate, cut the interest rate by 0.5%. They might cut interest rates even more during their regular March meeting. So we monitor the situation, but as I said, the outcome of the virus is very is unknown. That's why a lot of these things are speculations at this point. So on the surface, when we look at our macro and micro analysis, when we forecast the sectors to outperform, we see communication services, staples, industrials, IT, and materials scheduled to outperform, which is a pretty cyclical, pretty bullish indication. At the same time, we see financial real estate neutral, energy, discretionary, healthcare, and utilities on the negative side. What's interesting about our sector forecast, though, is that we see early signs of consumer staples and utilities turning the tables. And if we continue seeing that in the future, there's a higher chance that we will see some sort of a technical recession in 2021. If the virus continues to spread, we might see the recession in 2021 by judging by the traditional indicators and induced by the virus, by the slowdown in economic activity because of that. We still believe the recession is going to be short-lived if it happens in 2021, and you kind of almost need that because first of all, we will have another turnaround. We will have the turnaround in the leadership in the stock market, and we will probably see some mean reversion and change in the leadership in the marketplace, which is actually healthy for the stock market. So stay tuned. We're not saying the recession is imminent, but there is a higher chance, the chances are growing, that we will see a recession in 2021. And again, this is the macro view, and this is the micro view. So you see from the micro view that we have consumer staples and utilities turning green. So as I said, we do favor barbell approach. We can't really factor in the impact of a virus because there's so many unknowns. But what's obvious is that the global economy is going to slow down in the first half of the year. Let's take a look at the factors on the micro level. So we have in our universe, we have 3,500 stocks. We analyze hundreds of factors, but most of the factors which describe an individual stock fall into one of the following groups you see in this heat map: value, yield, growth, momentum, profitability, and safety. So the stocks with more distinguished, which score well in those categories, are compared to the averages of the market. In this case, we're comparing the large caps, the top two quantiles of our large cap universe versus S&P 500 on average. So you can see that lately value again and yield became very negative. Those are more of a traditional value factor groups. And growth, profitability, and safety are turning around, and especially growth and safety. You can see that they're becoming much more dominant, which is a very natural reaction of investors to unknown. The fear prevails. People run for well-recognized, what perceived to be more stable names. So a pretty natural reaction in the marketplace. Our portfolio is very well balanced. You can see that this is the polar chart of our strategical equity portfolio. We still have the portfolio composed of almost 50 stocks, mostly large caps, mid caps, no small caps anymore. And I'll talk to it a little more in detail later in the presentation. But at this juncture, we have very good exposure to growth. In green is our portfolio. In orange, all the stocks, all the viable stocks from the 3,500 universe we have. And the circle in the middle is the market. So you can see that our portfolio is very well exposed to factor groups which are most important to the long-term performance and to the long-term results. The only area where we are underrepresented right now in comparison to the viable stocks is the yield in this portfolio. This portfolio is more of a growth, long-term appreciation portfolio. So over the last year, we had a whole bunch of sectors which contributed to our portfolio performance and results: consumer services, consumer discretionary, financials, industrials, materials, real estate. Things which kind of suppress the showdown a little bit are consumer staples, healthcare, information technology, and utilities. But all in all, we had a pretty good 2019. Changes in the portfolio. So we keep some mid-cap tilts, but we really have no small caps in the portfolio at this juncture. We're keeping a neutral posture with some, GARP representation. But as I spoke before, we do have a barbell shape. So we do have some real strong growth companies and some value companies along with GARP. So very, very well diversified portfolio. In terms of economic sectors, we've overweighted industrials, IT, and we're closing gap in consumer staples. As you can see, this portfolio is very well diversified, has all 11 economic sectors. And in terms of the style representation, by our classification, we're still very well represented: large cap growth, a bit less large value, mid caps are very well represented, and no small caps. And when we take a look at the Morningstar classification, you can see that we have pretty good GARP representation, and which is kind of a combo of growth and value, and still very healthy value representation. But right now, the emphasis is the barbell plus GARP representation. And Here we do have a couple positions small cap, but we really consider them mid caps by our classification. Our strategic dividend portfolio, its whole mandate is to produce dividends for clients. So we maintain large cap posture in the portfolio with the value tilt, and we made some trimming in IT, bumping consumer staples to reflect our macro view and our sector forecast. So still very well diversified portfolio. Obviously, this portfolio is going to be value tilted just because we have quite a few companies. I mean, all the companies paying dividend in the portfolio. So let's talk about Signet Strategic Small Cap portfolio. We started this portfolio 3 years ago. We've had live results with several of our accounts. It's a fairly timely strategy, we believe. As we previously discussed, large cap has been outperforming small cap for a long time. Usually those outperformance cycles are 3 to 6 years old, so it's long overdue for small cap to lead the way. And we believe with conditions where we have some sort of distress in the market, one could be a recession, where managers across the globe start slowing down IT purchases, that will impact the sales of large growth IT firms, which have been leading the way for the last few years. And we could see a change in the leadership in the marketplace. Also, a lot of funds in the world have been redirected from small cap to private equity firms. And for the most part, private equity firms invested in cloud technologies. And that also, the slowdown in IT spending could bring or could depress private equity a little bit. So that could reroute some of the money towards small cap as well. So we believe investors should have some exposure to small cap, and we think our portfolio provides that exposure in a very efficient way. So we select out of Russell 2000 constituencies, and Russell 2000 is a small cap index, about 125 to 200 positions, depending on the rebalancing. Those companies are very fundamentally strong entities, and so what we do, we throw out the garbage from the portfolio, from the Russell 2000. A lot of companies in the index do not make money at all and are unprofitable for a very long time. So we rebalance the portfolio semi-annually in the fall and in the spring, and that way we avoid getting caught when the index is getting rebalanced, because every time it happens, the companies which are being sold from the index get depressed because everybody keeps selling them, especially those ETF providers which mimic the index. And the companies which are being added to the index are getting inflated because a whole bunch of investors have to buy them. So we avoid those inefficiencies. Our portfolio is very well diversified. We have all economic sectors represented right now. At the moment, we do not have active posturing, so we do not overweight or underweight the sectors in comparison to Russell 2000. We are also neutrally postured with regards to value growth. And because we have quite a few names in the portfolio, we can actually very easily do tax loss harvesting, sell the companies which have negative return and replace them with equivalents. So you can see that our portfolio has all 11 economic sectors with financials, healthcare, industrials, and IT at the top of the list. Very well balanced. We have small cap value, and small cap growth, pretty much evenly distributed. We have some mid caps in the portfolio and even a little bit of large caps. So those are the companies which have grown really fast and went through the thresholds to become mid and large caps. So that concludes this presentation. I would like to also speak real quick about the recent volatility in the marketplace. As long as you understand that equity exposure is a part of long-term plan, you shouldn't lose sleep over the volatility. If you start feeling uneasy about the recent volatility, we encourage you to reach out to your advisor. We do not recommend reacting into the panic, because usually when people are, panicking, their decisions are not as rational as when they're calm. So we would like you to stay the course, let your long-term asset allocation work for you. But if things need to be changed, please reach out to your advisor, and we'll definitely have a discussion and conversation with you. Thank you so much for your attention, and have a wonderful day.